Welcome back to our channel, where we'll help you go from a newbie to a savvy real estate investor. In this video, we're going to show you some of the strategies that real estate professionals use to avoid depreciation recapture taxes on the rental properties. So if you're trying to sell a property for a sweet profit and you're worried about paying capital gains and having your profit being eaten away by depreciation recapture taxes, stick around because we're going to show you some different strategies to help you keep more of that hard-earned money in your pocket. First, let's take a deep dive into what depreciation is. Depreciation is a tax deduction that allows real estate investors to recover the cost of income-producing property over a period of time. In residential real estate, that's typically 27.5 years, and in commercial real estate property, it's basically 39 years. And that tax benefit allows you to offset your rental income with a non-cash, otherwise known as a phantom expense, ultimately reducing your taxable income. It's one of the benefits associated with being a real estate investor. To further illustrate this concept, let's consider a simple example. Suppose you purchase a real estate property for $275,000, excluding the land value. Using the 27.5-year depreciation schedule for residential properties, you would be entitled to claim a depreciation expense of $10,000 per year, so $275,000 divided by 27.5, which would equal $10,000. That means that each year you can deduct $10,000 from your rental income, which lowers your taxable income and potentially saves you thousands of dollars in taxes. And that is a beautiful thing. But what is depreciation recapture? Well, when you sell a rental property that has already been depreciated, the IRS requires you to pay taxes on the portion of the gain that is attributable to the depreciation deductions that you've already taken over the years. That is called depreciation recapture tax. And it can catch some investors off guard. It can catch some folks by surprise if they're not really prepared for it. Depreciation recapture tax, it's calculated at a maximum rate of 25%, and it's applied to the lesser of the total depreciation claimed or the gain realized upon the sale of the property. For example, if you claimed $50,000 in depreciation deductions and you eventually sold the property for a $60,000 gain, then you would owe depreciation recapture tax on the $50,000 in depreciation, not the full $60,000 gain. So, how can you minimize or avoid depreciation recapture tax altogether? One popular strategy is the use of a 1031 exchange. A 1031 exchange allows you to defer capital gains and depreciation recapture taxes by reinvesting the proceeds from the sale of your rental property into another like-kind investment property. That allows you to continue growing your real estate portfolio while deferring taxes on your gains. If you guys are enjoying this video and want more tips on maximizing your investment portfolio and minimizing your tax burden, make sure to hit the like button and subscribe to our channel. Another strategy to minimize or avoid depreciation recapture tax is to sell the property before the recapture period ends. If you sell your rental property before the end of the depreciation period, you may be able to avoid or reduce the amount of depreciation recapture tax that you owe. However, this strategy requires careful planning and timing, so it's important to consult with a tax professional before implementing it. For example, if you've owned a rental property for 15 years and you've claimed depreciation deductions during that time, you may consider selling the property before you've exhausted the entire 27.5-year depreciation period. By doing this, you could potentially minimize your depreciation recapture tax liability. However, keep in mind that you may still be subject to capital gains taxes on the sale of that asset. And always be sure to think about the time value of money. Many investors use cost segregation studies to accelerate depreciation in order to take more losses up front. That's great in the near term, but you could be left with a hefty tax bill resulting from depreciation recapture if you don't prepare accordingly and you sell a little bit earlier on during the holding period. This is why we much prefer the buy, improve, and hold strategy over at Sunrise Capital Investors. We try to help as many folks as possible generate cash flow and build legacy wealth in a tax-efficient manner, because ultimately it's not about what you make, it's about what you keep. So we try to minimize those capital gains taxes and defer capital gains taxes and defer depreciation recapture as far as the eye can see. A third strategy to minimize or avoid depreciation recapture tax is to convert your rental property into your primary residence. When you do this, you may be able to exclude some or all of the gain from the sale of your property from your taxable income, which can help you avoid or reduce depreciation recapture tax altogether. However, there are specific rules and requirements that you must follow in order to qualify for this exclusion. So be sure to speak with an appropriate tax professional to ensure that you're in compliance. In order to qualify for this primary residence exclusion, you must have owned the property for at least 5 years, and you must have lived in it for at least 2 years in advance of selling that respective asset. Additionally, you can only claim this exclusion once every 2 years. So if you meet those requirements, you may be able to exclude up to $250,000 in gains or $500,000 for married couples filing jointly from your taxable income, which can significantly reduce or altogether eliminate your depreciation recapture tax liability. Finally, you can also use bonus depreciation to minimize or avoid depreciation recapture tax. Bonus depreciation is a tax incentive that allows you to deduct a larger percentage of the cost of qualifying property in the year it's placed in service. And this can help offset the potential depreciation recapture tax when you sell a given property. It basically means you'd have to sell one property, you've got a little bit of a tax bill. If you buy another asset, use a cost segregation study, and implement accelerated bonus depreciation, the depreciation benefits from that second acquisition can help offset this additional gain. However, please note that bonus depreciation is subject to very specific rules and limitations, so again, it's important to consult with a tax professional to determine if this strategy is suitable for you and your specific situation. Before we wrap up, guys, make sure you hit the subscribe button for more tips on real estate investing. We've got plenty of valuable content that we put out each and every week to try to help you along your journey to become a successful real estate investor. As a thank you for watching the entire video, guys, we got a free gift for you in the description below. We're here to help you with any and all of your passive investing needs, but it's no secret that our favorite asset classes are mobile home parks and parking facilities. It's what we do every single day, and we know it like the back of our hands. So, if you want to learn more about what I feel like, in my humble opinion, is one of the best real estate investment sectors available in the marketplace today, click the link below and you'll get our free guide, The Passive Investor's Guide to Parking Lot Profits.